So you shouldn't have to be a millionaire in order to be an accredited investor. That's what our good friend Congressman Huizenga said when he introduced the Accredited Investor Definition Review Act, which isn't law yet, but it actually just made it out of committee last week by an overwhelming majority. 41-2 was the overwhelmingly bipartisan vote from this Accredited Investor Definition Review Act. This act will require the SEC to incorporate additional certifications, designations, or credentials that further the purpose of the accredited investor definition within 18 months of this law passing. So let's look at the actual language of the act, and then we'll come back and we'll talk about where we are currently in the accredited investor definition, how do you become an accredited investor, and how it really fits into the other couple of moving pieces that we have. And then obviously we'll open it up to Q&A, and we'll obviously timestamp all the questions so you can search easier. So the language is actually pretty it's pretty simple. I'm just going to read it to you guys because it's really hard to find on the internet. Just like I said, it literally passed last Wednesday, so less than a week ago. But it basically would update the definition to include a separate section that simply says that an accredited investor would also include an individual holding such certifications, designations, or credentials as the SEC determines necessary or appropriate in the public interest or for the protection of investors, where such lists of certifications, designations, or credentials shall be no less broad than those certifications described in the amendments made in section so-and-so of the code, which was actually the final rule that the SEC came out with. It's been like 2020 now. So it's relatively similar, if not very identical, to the rule that already was passed by the SEC, the commission on its own. But what this does, obviously, is it's coming from Congress. It's an edict from Congress. So it really puts pressure on the SEC to actually get around to implementing the rules that it said it was going to implement. But it's been now, I think, 3 years since the SEC came out with that rule. So we're going to talk about that rule in a second. But let's talk about where we are now. I guess, what is the current definition of an accredited investor, and how does one become one? Let's talk about that first, and then we'll get into some of the newer developments. So an accredited investor generally is someone who has $1 million in net worth, excluding their primary residence. This is how you generally become an accredited investor. Or if you've earned $200,000 the last 2 years with a reasonable expectation of earning that much this year, and if you want to combine that income with your spouse, it's $300,000. Interesting thing is you have to actually pick and choose which method you're going to pick over the last 2 years. So if you want to do it just you got to do that for all 3 years. If you want to combine it with your spouse, you've got to do that consistently throughout the 3 years. If you're an entity, generally, if all the investors or all the members of that entity are accredited, and then the entity itself is going to be an accredited investor, or if the entity has $5 million of assets, then it will qualify as an accredited investor, so long as those assets were not just raised for the purpose of making an investment, because that would kind of be a way around that. So that's where we were until 2020. And then in 2020, the SEC updated that rule and gave us a couple of other ways that you can become an accredited investor. And those are if you are literally have certain licenses for securities licenses, Series 7, Series 82, Series 65. Those are the three that the SEC said, hey, if you have those licenses and you are registered with your particular state and you're in good standing with your particular state, then you will be, by definition, an accredited investor. So that's one of the things that you can do as a non-accredited right now. If you don't have the economic wherewithal to qualify, then you should look into one of these licenses. And with my research, I think Series 65 tends to be the easiest one to do. It's actually not that complicated. When I say easiest, doesn't mean it's easy. It just means it's the easiest. First of all, it doesn't require you to be sponsored by any firm. You can create your own firm. You can just take the exam, and then you can go ahead and apply with the state. I would recommend that you hire a consultant. I mean, it's still a little bit muddled. I did a step-by-step checklist, and I'll put a link to that in the show notes below, sort of a step-by-step checklist of how to get that Series 65. But if you don't have the income or net worth right now, the easiest way to become an accredited investor, if you're not, is to take that Series 65 and get licensed. That's where we currently stand today. Now, there's been some rumblings that $1 million threshold is going to be increased. There were some reports last year that said that they were considering upping that to 10 million. I don't think it's going to be that much. In fact, if you read the articles from those articles like a year ago, if you really do a deep dive, you'll see that it really wasn't 10 million. It was more clickbaity, which is fine, but they are looking to address the accredited investor definition. They are, I think, going to be increasing it. I believe that that number is going to be closer to 3 million, just because the $1 million number is from 1982. And it's been a while, over 40 years now that definition has been in place. And if you just adjust for inflation, that $1 million number gets to almost 3 million. So my guess is that they're going to eventually increase the definition to 3 million. And so if you don't qualify as an accredited investor anymore, then you're going to have this alternate route of getting certified. Now, the SEC was supposed to be rolling out these certification programs. You know, obviously somebody has to have the license to give the exams and to actually certify people. That just never came out. And from what I've been reading, it's really sort of a battle between those who want to have increasing this limit versus the people who want the certification. This is kind of a striking a balance. So I do believe that when they do actually come out with the new increased accredited investor, assuming they do that, that at that point, they'll actually start rolling out the actual certification programs. But what Congressman Huizenga was trying to do with the Accredited Investor Definition Review Act is make this a congressional mandate and telling the SEC that you've got 18 months to come up with the certification programs, and you've got to do it such that, you know, income, net worth, being the millionaire is not the only way for you to get access to these sometimes lucrative private placement investments. So that's kind of where we are right now on the accredited investor definition. I am literally checking daily the SEC website to see if there's an update as to when the update, you know, when a proposed rule is going to come out or when they're going to have their discussion. And of course, as soon as that happens, we'll make sure we probably do a live at that point, since I want to do it as sort of breaking news. So anyway, that's where we are on the Accredited Investor Definition Act. We'll start with some questions. If you've got questions, just drop them in the chat, and let's go with it. Jeff asked, do you need to file as an RA if you just passed a 65? Do you need to file as an RA? Yeah, you have to be a registered investment advisor in good standing with your state. You can either go at the SEC level or you can go at the Fed level, but unless you've got over $100 million in assets under management, which I'm presuming most of us don't, then you're not even eligible to apply for the federal side. So with a Series 65, it's actually not that complicated, to be honest with you. I did a checklist on how to do it. And you do have to pass, obviously, you have to take the exam, you have to pass the exam, you got to fill out an application. It's the only one that doesn't require you to have a sponsoring entity. So you don't have to be sponsored by any investment advisory firm. You basically just create your own firm, you know, set up an LLC, register that as a firm, and then you can hang your license under your own firm. My recommendation, to be honest with you, I mean, this is certainly not my field. I know there's services out there that will just handle all the paperwork and get it all done for you for like $3 or $4 or $5 grand. So that's what I would do. I would literally go through the process, hire a consultant, and then have that consultant help me get through the process. But getting a Series 65 isn't the end of the world. And if you are a passive investor that really wants to participate in some of these offerings and you're not close to the thing, or if you're an accredited investor that's soon to be a non-accredited investor because they're going to raise it to 3 million, then that's something you may want to take a look at. And then the other thing to point in mind, that if you are relying on accredited investors, those may become non-accredited. So this is the time that you probably want to start reaching out to all your investors and starting to establish those pre-existing substantive relationships, so that these accredited investors that you thought you could get in before, maybe you need to go back to a 506B and start getting these investors into your deals because they're no longer going to be accredited. Greg, so Mauricio, looking to assemble a team or required players to set up a fund. How do I go about this? And if the fund is in Florida, can you do the legal work? Yeah, so a fund, just FYI, the fund follows securities laws. And so it's going to be the same rules, register, find an exemption, or it's illegal. We're always going to look for an exemption. These are all federal exemptions. So we don't actually we're not going to be touching Florida law or California law or Texas law. We actually don't worry about the state laws, which is kind of the nice thing about it. So we're able to do these in all 50 states. In fact, we do them all over the world. There's a lot of clients, not a lot. We have a few clients that are raising capital that are outside the United States for outside projects, but this is all US stuff. But, I think, how do you go about getting that team? I can tell you who the team players are from sort of a vendor standpoint. I mean, obviously you need and I was thinking about doing an episode of this, you need your SEC attorney, obviously, but there's also a couple of other attorneys you may need. You may need a real estate transactional attorney. In fact, I think everybody should have a real estate attorney handling. I don't understand how some folks are raising millions and taking down multi-million-dollar apartment buildings and not using an attorney to review, not only draft the PSA, but also just review all the reports and just make sure there's no issues with the whole transaction and negotiate on your behalf, not only with the seller, but also with the loan. And it's all paid out of the project. So I'm not quite sure why some people skip that step. We don't do that at Premier, but we're happy to refer you to someone. That's one of the benefits, I will say, Greg, of working with somebody like us, or somebody who, you want to be working with a team member that has other team members that they can refer you to, right? So, we may not do in fact, we don't do real estate work specifically or transactional work, but we have plenty of people that we can refer you to and make introductions to. So that's one way to do it. You also probably want to be talking to some kind of an asset protection attorney, entity formation attorney, to help you make sure you're structuring it properly, making sure you're protecting your assets and making sure you're segregating the liability from yourself on this particular project with, your other assets that you have. You may be looking for an estate planning attorney to make sure that it's all, I think everybody needs to have a living trust, for example, and a will, obviously, but a living trust for sure. And so these are all sort of on the legal side of, it's not just your SEC attorney that you're going to need. And then obviously you want to have a really good CPA on your team, somebody that represents syndicators, because that's a different world than just somebody who does, regular tax returns. So obviously somebody who knows real estate, ideally has invested in real estate and knows the code about real estate, but really somebody who knows syndication work. But Greg, at the end of the day, I think the best way to find team members, other than going to conferences and meeting them that way, is having somebody that you already have on your team and getting referrals from those people. Because I think my good friend, I don't know if you guys know Beth Clifford, but Beth always used to say, look, an A player, an A person on your team shouldn't cost you money, it should make you money. And one of the ways they make you money is by making introductions to other A players, other great CPAs, other great attorneys, other great vendors, brokers, lenders. I know I see Anton in here who helps on the lending side. So again, I think getting referrals from people or attending some of these events and just getting to mingle with people. Bobby, can you go over how fund managers can work with broker dealers, and is it worth the effort or cost? So we don't see too many. I mean, it's a great way to do it, but at our level, and this is the reason why this rule had passed, or at least the proposed rule had passed the SEC. At our level, when I say our level, I'm talking, less than 100 million, 50 million, 30 million, 10 million, 5 million, small potatoes. Most broker dealers generally don't like to get out of bed for less than 50 million, $100 million deals, right? They're not going to put all this time and effort and put their relationships in when you're raising 2 or 3. I'm not saying there aren't any, but it's just hard. And so it's tough for us because on the one hand, we need to use the broker dealers. On the other hand, we're at a smaller level. So there's that little gap between where we are, after you need to raise a little bit more money, but not quite that much. And but you can work with, if you can find a broker dealer, maybe it's a newer broker dealer that's trying to establish their own book. If you can find a broker that has clients, has investors, the cool thing about that is that they're the ones that have to have the pre-existing substantive relationship, not you. They're the ones that have to have the relationship with the investors, and because they're broker dealers, they're just going to charge you a commission. Now, I've seen commissions vary from a straight commission where, hey, just pay me 8% of all the money I bring in. So if I bring you $1 million, you're going to pay me 80 grand. If I bring you $10 million, you're going to pay me 800 grand, et cetera. Or at the smaller levels, so we do have some clients that have used broker dealers, what we see is a hybrid, which is like they'll take a smaller percentage, maybe 2 or 3% of what they raise, but they'll take a cut of the GP depending on how much money they bring in. So that's what I've seen mostly for the GPs, for the broker dealers that I've seen at our level when people are raising 3, 4, 5, 10 million, and they do have a relationship with a broker dealer. It's usually the hybrid model where it's a smaller straight commission coupled with a percentage of the GP based on how much money they bring. And because they're broker dealers, they're allowed to do that. If you're not a broker dealer, then you can't charge a transaction-based compensation. Jeff, I am exempt. You're an exempt investment advisor in Iowa. Would that count? I'm an exempt investment advisor in Jeff, the SEC, at least for purposes of being, assuming we're talking about for the purpose of being an accredited investor, the rule from the SEC specifically references licenses of the Series 7, Series 82, and Series 65. So if you're an exempt and you haven't taken one of those exams, I'm going to say no. But that's what the rule says. It's got to be. It's not that you just have to be an investment advisor or registered anywhere. You have to specifically have passed those three. And I'll be honest with you, I don't know what the difference is between those three. I haven't taken those exams. I don't know why those three are that much different from the others. I know there's a ton of other series, but that's what the rule says. Justin, hey Justin, most accredited investor verification forms require a third-party verification like a CPA. That's correct, as you probably know. What are the risks to the CPA in signing those forms? Where are you, Justin? There's a lot of risk to the CPA, which is why it's one of the reasons we get so much pushback from CPAs. Usually, if you have a one man or one woman shop, then they're more likely to sign it because they want the business and everything. But I've found that if your CPA is part of a larger firm that has insurance counsel and all that fun stuff, then they're very hesitant to sign it, because you're literally offloading the responsibility and the liability of verification from you, the issuer, to this third party, which is the CPA. And so if it turns out that they're not accredited, right, and it turns out that they didn't take reasonable steps to verify, there's some potential exposure. So, and in fact, if you look at the rule, I wish I had it on a different screen, but if you actually look at the rule where it talks about that, there's actually a footnote and where the SEC acknowledges that. They can see how some CPAs may be hesitant to sign because of the consequences, but that's the way it's written. And I mean, I personally believe that for the cost of these third-party verification companies, there's so many of them out there, and they literally charge you, depending on the volume, can charge you as little as $30 or $40 an investor. But even if you only have a few, it might be 80, 90. Then it just doesn't make any sense not to use them. What I like to do on this is our own practice is that I've prepared, and you may have seen them, Justin, I've prepared CPA verification letters with the exact language that I like and quote unquote approve. And so if the client is able to send that over to the CPA and have it DocuSign, where they literally just put their letterhead and sign as is, then that's good for me, and they can save $30 or $50. They can save a few bucks. But if the CPA then wants to change the comma or delete this or change the wording, then it's like, it's not even worth. I mean, think about it. Your attorney's charging you, their hourly rates, what, $200, $300, $400, $500, $600 an hour. They spend 15 minutes on it, and you've already spent more than the $30, $40 it takes to go through a third party. And the third party is an attorney. So usually the third party, they do their verification, then you get a letter. Instead of getting the letter from the CPA, you're going to get a letter from the attorney. So yeah, is that Justin, that's probably a concern on your end, people asking you to write these certification letters?
Yeah, I get them all the time, and in most cases I can sign them without any hesitation, because in strategizing and doing tax strategy, I know they've got the real estate net worth to meet the qualifications, and I see the income every year. So without any hesitation, I can sign it. And I didn't realize that it was risky. But I attended a CPE course recently where the teacher there said, "Man, I would never sign those." And I thought, "What? I sign them all the time."
I get that. I've heard that from so many people. I mean, at the beginning, I think people were signing them, but that lately, and I think now it's coming back full circle, where I think they're kind of agreeing on the language that seems to like to. But I've honestly put my foot down. I've just been like, why are we even, like, the amount of time and resources it spends just having the conversation is more money and time spent just hiring the verification company to do the verification. So, but there are potential. I know that I know a lot of the insurance companies, the malpractice insurance of the CPAs, they're uncomfortable, or the version that they're comfortable with it doesn't always give the, like, I've seen versions that I just don't like. I just don't think that, I mean, they literally eliminate the key wording, which is Justin, have taken reasonable steps to verify that this person's accredited. I've done their tax returns. I've seen it with my own eyes, and I'm telling you he's accredited. That's what we're looking for. But when they start taking that language out, then it's not super comfortable for us.
Well, and we like the version that says that, based on the tax returns, what have you, but that has not been audited by us. That has been using information provided by the client.
Correct. And I think that's reasonable. I mean, obviously, if your client's committing fraud or because obviously they're signing the tax returns under penalty of perjury. And so if they're giving you false information and they're the one signing the returns. So right. I think you'll be fine there. But I don't know. I think some firms are just, especially if they're not I don't know. There is a concern there, and there is a potential risk there. I mean, that's the whole point. You guys are the reason the SEC is comfortable with you guys and attorneys and broker dealers signing these letters, because you guys are licensed, and so there's repercussions if you do it wrong. So that's why that's why they like it. Thanks, Justin.
Sure, yeah, thanks.
Robbie, some large syndication groups are saying fundraising is more difficult right now. I would tend to agree. Presumably due to the economy, I would tend to agree. Are you seeing a slowdown in syndication document requests for syndications right now? We are. We stabilized. So I'll give you a little insight into where we're at. So we probably, and by the way, I was on a panel with at the MFIN conference, and I was on a panel with a bunch of brokers as well. And it's the same story, just not only in our business, but also brokers and everybody. But we kind of all peaked in about June of last year, June, July. So it's almost been a year. That's when we were just like busy as could be. I think we had our highest volume month somewhere around that time, June, July. And then the second half of the year, with all that went going on, real estate prices in the multifamily space pretty much dropped about 20% with the cap rates going up. And so our volume went down significantly. And then that was in about October. And it's kind of leveled off. And I think we're starting to sort of tick up again in the last, couple of months, but it's still significantly lower than it was back in June of last year. And I think if you talk to brokers, I don't know if there's any brokers, if you guys want to raise your hands, but if there's brokers in the room, I want to comment there. But from everybody I've talked to, it seems to be a consistent theme that we peaked, middle of last year, or sort of May, June, July, and then bottomed in October, November. And, I don't think prices have gone down much more, if any, since then. Have been kind of stable. And the question is going to be what's going to happen here in the next, 6 months, if there's another shoe to drop, or if we kind of stabilize at this point. Raj, does transaction-based compensation regulation apply to property transactions, ex-condo pre-sales, for example, condo pre-sales for entities like technology platforms, or does the platform need to be licensed in any way? So the transaction-based compensation that I speak about is purely on the question of whether you're acting as a broker-dealer, because that's the issue that I see all the time, which is, most people are not licensed broker-dealers, right? Everybody that's in the syndication business tries to relies on what we call one of the exemptions. It's called the issuer exemption. And there's about 3 main things you've got to go through in order to get that issuer exemption. And one of them is you cannot get paid transaction-based compensation, because that is what they call the hallmark of broker-dealer activity. So anything that ties to me either raising the amount in exchange for compensation, or raising a certain amount in exchange for certain compensation. Again, compensation can be anything. It can be cash, can be GP interest, can be gold, can be farmland, can be whatever, right? As long as it's something of value. And so that's what I'm talking about, transaction-based compensation, whether you need it for, a technology platform or for something else.
Just let me clarify that. Yeah, Mauricio, just let me add one more comment there. I didn't explain that properly. So I understand that if we are raising equity, then the transaction-based compensation would come under that SEC regulation. But let's say we have a developer who wants to do a pre-sale on our technology platform and give a discount, like 10% discount on the condo to the investors who are buying through our platform. And so can we take a commission from that? They're not actually giving equity. This is just selling condos on the platform.
Yeah. So, I think at that point, you've got to look at the specific industry. So, for example, I believe for example, if you're in the real estate world, somebody can correct me if somebody's a real estate broker that's on the call. But if you are, if I refer somebody and want to get some kind of a commission for referring someone on the real estate side, you've got to be a real estate agent or a real estate broker, not a broker dealer, not an SEC license, but I got to have that licensing in the real estate world. I don't know if that also applies to the technology space. That's a little bit outside of my comfort zone or where we're all. But I think that's more of a question, really. The way you frame the question is for a real, again, we're not real estate attorneys, but a question for the real estate attorney, because the question is going to be, I definitely don't worry about you having to be a broker dealer, but because you're not in the, because broker dealer only applies to the sale and transaction of securities, and it sounds like
Right.
you're not, your example is not a security, it's just a condo or whatever. Which, but by the way, condos can they can be securities, but let's assume it's not a security, then it's not going to be broker dealer activity. But again, I believe you have to have a real estate license in order to receive a commission for referrals or things like that. So that's a question I would ask for a real estate / transactional attorney.
Got it. Thank you.
Of course. Thanks, Raj. Yeah, Bobby says he's licensed. You need to be a licensed and the broker can get the referral. Now, this isn't necessarily a referral. I guess this is more of a, well, I don't know if it's a referral, whether you're just getting a cut of a deal, but yeah, I would definitely look into that world of the real estate side. Mauricio, is there somewhere that newbies could go to get download PPMs, OAs, investor questionnaires, subscription agreements, and other related documents as to what to expect? You know what, I mentioned this at some other time too. I'm going to put it in the chat here. So there's the website for the SEC. There's their system is called EDGAR, EDGAR. I forget what it stands for. Electronic Depository something. But every time there's a Reg A, for example, and that's where by the way your Form Ds get filed and everything like that. So that's not super exciting. But if you do a Reg A, or actually even a public filing, you're going to file your PPM subscription agreements, all that information with the SEC for their approval, and that's public records. So anytime you guys want to see a PPM, you can always pull one off the internet in terms of if you're looking for a template. I would definitely, when I say template, a sample, it's completely worthless to you because the PPM is only as strong as the information you're going to put into it. And so the information has to come from your specific deal, your disclosures, and whatever your attorney believes is relevant material for the deal. But if you're looking for examples, I actually sometimes go in there if there's a particular asset class that I haven't done very much of. Let's say, for example, I remember doing a deal where we were doing a franchised hotel, not only just a hotel, but they were actually buying a franchise like a Holiday Inn or one of these franchises. And so I was able to find a bunch of PPMs on the EDGAR system that had all the risk disclosures and things you needed to worry about, specifically on the topic of brands, right? And so there's stuff that I didn't even think of, like, oh crap, I didn't even think of this, all these particular issues that you'd have to worry about, all these risks that are associated with buying not just a hotel, but a branded hotel and entering into a licensing agreement. And so that's just a good resource, I think, in general. Go into EDGAR and it's a great search tool. You can literally just search multifamily or whatever you have self-storage, and you'll pop up a bunch of different documents and you'll stumble across PPMs and subscription agreements. So that's a good source that I would recommend if you're looking for sort of samples or ideas. Ones on the internet suck. Yeah. The problem, it's not that they suck, it's just that a PPM is just like a pipe, right? It just takes you from point A to point B. It's what you put inside the pipe that actually is the valuable piece, right? And so the PPM, I always call it's just a conduit. It's the information that you're putting in there that brings it value because you're disclosing all of the material facts about your deal, all the risks, all the information about the loan. So the one on the internet, other than maybe some of the generic, risk disclosures or something, but even then you'd want to know who drafted it. The nice thing about EDGAR and on this particular example, I found a couple of PPMs from Hilton. And so I know the folks over at Hilton, I know their legal department. So if they drafted it, I felt pretty decent that it was a pretty good language, but I still then massage that and put it into my own words and make it specific to the client that we were dealing with. So anyway, but EDGAR's a great resource in general. Thanks, Greg, for putting the link on there, and the search box is great. Just put it in there. Anton, Raj, for the platform that receives compensation in one form or another for deal sponsors, I would seek out an advice from a FINRA attorney. There you go. Even another, we do not deal with FINRA, but thanks, Anton. Appreciate it. Good to see you, my friend. Oh, one more question here came in right at the wire, Douglas. What type of fund would be ideal to raise funds to start a company that in turn would invest in manufacturing? What type of fund would be ideal to raise funds to start a company that in turn would invest in manufacturing? When you're talking about the type of fund, it's all the same, right? So from a structural standpoint, it's going to be an LLC or an LP. Most of us use LLC. I don't know any reason why a manufacturing fund would be an LP. The only ones I like to do LPs is literally oil and gas deals because there's some tax benefits to doing that. But generally speaking, let's do an LLC. And then again, there's two things you're doing, Doug or Douglas. Number one is you're raising capital. And then the second thing is you're deploying that capital somewhere. Most of us are deploying it to invest in real estate. Some of us are now starting to deploy in the purchase of securities because they're buying shares in another company, fund of funds. But you could obviously raise money for anything. So some people are in the cannabis business and they're raising money to buy, cannabis farms or other businesses. So whether it's manufacturing, whatever, the only thing you need to be concerned about at that point is whether there's some kind of licensing that you would be required in order to invest in manufacturing, which off the top of my head, I don't know of any. I don't see any reason why to. But obviously, if you're investing in the stock market or if you're investing in something that's regulated and licensed, you may need a license. But in manufacturing, I don't think there's anything specific that you would be looking at. So I would just create an LLC, probably in the state where the manufacturing company that you're investing in is. And I would raise capital and you'd have a PPM and you'd have to figure out what the exemption, because obviously you don't want to register it. So what's the exemption? Is it 506B, 506C, Reg A? Same analysis as everything, but instead of buying a piece of real estate, you're going to be investing in a company or buying a company, or maybe it's your own company. Just disclose it that it's your own company. So that's there's nothing special. I guess my answer is there's nothing special about the fact that you're investing in manufacturing versus, self-storage versus multifamily versus oil and gas versus any of that stuff. Yes, Andrea, Wednesday, 4:30 p.m. Mauricio will be switching these lives. Thanks, Jody. Same time Wednesday, same time. And it's going to be the same link. We're actually I should have done that today, but we'll change it. So it'll be the exact same link. It'll be, from your perspective, it should look the same. It's just that it's going to be Wednesdays. Anyway. All right, guys, we'll see you a week from tomorrow. And don't forget the Drunken Real Estate podcast coming out on, I believe, Friday. All right, guys. Thanks, everyone.